Ladies and gentlemen, welcome back to the channel, and welcome back to another very turbulent day here on Wall Street, heading into the main catalyst of this week, which is going to be Fed Jerome Powell on Wednesday, 2 p.m. The FOMC report comes out. It will give us guidance to what to expect, what the Fed is going to do at that meeting, what kind of rate hike increase we are going to get, what the balance sheet reduction will look like, so on and so forth, what they are going to do throughout the next following months. Now, specifically, I want to talk about the macro environment here. I want to talk about the stock market in a whole. Yes, we will go over Sofi stock, the short interest, the option activity, yes, all of that. And I will point out right here that Sofi stock is up 1.39% today, so it's obviously a great day for Sofi stock, and I don't want to minimize that at all, but I think there's bigger macro trends going on that I think you guys will find a lot of value out of. So hit the like button, subscribe to the channel, do what you guys got to do if you guys like these kind of videos. Thank you for tuning in. No matter where you are, no matter what you are doing, it is always a good thing to get your stock market education on, baby. So first things first, the SPY is down about 1.35%. I want you to pay attention to this. The SPY bounced off of 405.02. So 405 is going to be the key level that we want to watch by the end of the day today. If we go under 405, it's very possible we could close the day down, 404 to 400 on the S&P. Now, the lower the SPY goes into the Fed meeting, potentially the bigger bullish reaction we could see after the Fed meeting, or vice versa. If over the next 2 days the stock market goes up, let's say 5%, we have a 2.5% green day back to back to back. I don't see that's likely. It's possible. I'm never going to say it's impossible here, given the current state of our markets. But nonetheless, if we do drop into the Fed, you're likely to see a bullish reaction. If we do rally into the Fed, you're likely to see a bearish reaction. And that's what we've seen during the last Fed meeting. You've seen this back here, March 14th, March 15th. The markets were crappy going into the Fed, and then what happened? The markets ultimately had a historical rally, pretty much going straight vertical on the S&P 500 after that. Now, I will say when it actually comes down to what the Fed is going to do, reducing the balance sheet and raising rates, it's very, very important to know that where we currently sit right now, the Fed could not accommodate the markets or, the economy overall if a recession happened. Now, we just did get a negative GDP print of 1.4% for Q1. If we get one more negative print for Q2, then you are in a technical recession. Now, what does the Fed always do before a recession happens, right? Let's go ahead and pull this up. Fed's funds rate. You can see the Fed always raises rates, then a recession comes, right? Fed raising rates, boom, stabilized, dropped a little bit, recession comes, they cut rates. Rising rates, levels out, recession comes, that's the gray lines right here. Fed cuts rates, recession, boom. Rising rates, this is probably the time period a lot of you guys might know. From 04, the Fed raised rates from 1% to 5.25% until 07. Recession comes, Fed cuts rates. Same thing from 2005, from 0% all the way to about 2.4%. Recession comes, COVID, rates go to 0. Now, the rates are not in a place where they could accommodate the economy if a recession does come. So if we are getting closer to a recession and the Fed has rates at these stupid low levels, then what does the Fed do when a recession actually happens? That's the kicker. There's nothing they can do about it. So surprisingly or not, I've been hearing a lot of people say, especially economists, are pretty much saying that, hey, as the economic outlook gets worse, as growth slows down, maybe the Fed won't be as aggressive raising rates. And I actually think it's the opposite. If the Fed is getting wind that the economy is slowing down, that a recession is here on the near-term horizon, the Fed will potentially have to raise rates at a faster pace so they can come in and accommodate the markets by cutting rates when a recession actually comes. The last thing you want is high inflation, a recession, and federal funds rates at pretty much 0. That's the last thing you want. That's a recipe for a 5 to 10 year long downtrend in the economy or in the stock market. I don't think the Fed will let that happen. I think they're either going to go very aggressive or, the economic outlook, the data will start to look a little bit better. We will not get a negative print next quarter for GDP. Something will happen, and it will either be a very bullish thing or a very bearish thing for the broad markets, and you're going to see a big reaction after the Fed on Wednesday. Either the markets will rally big or they will falter through the floor. There's literally no other way to put that. The markets will move big based off of the Fed, and that is going to be the main catalyst. But what is causing a little bit of this downward move today? You actually did get ISM manufacturing data today. This is basically showing like how expensive, or was it PMI? Hold on one second. No, it was ISM manufacturing PMI. That came in worse than expected. But on the flip side, it did show that the cost for manufacturing is starting to slow down a little bit. So that is seen as bad and good, but more so weighted to the bad side. And that is definitely what is not helping the markets today. It's driving the markets down just a little bit. Now, tomorrow you have JOLTS job openings for March. And surprisingly or not, keep in mind what I'm saying. If the labor market starts to slow down, as well as the economy slowing down, it could be seen as a reason for the Fed to go a little bit faster. And then on Wednesday, obviously, you have the ADP non-farm employment change. That will be important. That's something the Fed pays very close attention to. ISM non-manufacturing PMI. And then you do have crude oil inventories. And then at 2 p.m., you have the FOMC statement, and then Fed interest rate decision, both of those at 2 p.m. And then at 2:30, you have the FOMC press conference. And that's going to be most important, I believe, just because that's when the markets, tend to react in one way or the other, right? That's what ultimately tends to move the markets in a very substantial way. So that's going to be very, very important. Just keep all of that in mind. I'm not a fortune teller here. I don't know exactly what is going to happen, but I know it's going to be a very big deal coming Wednesday, and the markets are going to pay very, very close attention to that. Now, as far as SoFi stock, SoFi is up about 1.23% today after hitting a new all-time low at $6.01 per share. So I think that's important to point out. All of these, certain stocks, like even if you look at Apple, is down quite substantially today, whereas you have SoFi stock that is actually positive. Apple is down 2.18% today. And I think that goes to show kind of what I've been saying. Once you get closer to a bottom, a lot of the stocks that have pretty much been beaten down over the last, 6 months are going to be the ones that recover a lot harder and a lot faster than your large cap tech stocks once they ultimately do go down. You will see, a huge rally once that ultimately happens. I don't know if it'll be Wednesday. It could be after that, but you will see a big rally here, in my opinion, here in the short-term future. Now, as far as SoFi stock and the actual Ortex data, as far as the option activity, you're looking at one order totaling $358.53 thousand, positive order value of 100%. Again, a lot of short-term bearish activity on the put side for the options chain. But for the January 2024, the $5 calls, you're seeing a lot of activity there. A lot of activity for January 2023 $7.50 calls and January 2024 $10 calls. So it looks like a lot of short-term bearish activity, a lot of long-term bullish activity for SoFi stock, and that is ultimately a good thing to see for any of my long-term investors out there. Now, the short interest of free float is currently sitting at 19.79%. Current shares that are sold short, 143 million. Cost to borrow max at 2.73%. Utilization at 100%. And days cover sitting at 3.86. So, put that into context, 20% of the float is sold short. Once that bounce inevitably does come, then I think it's very, very likely that you will see a massive rally in SoFi stock, as well as a lot of stocks that do have a very high short interest. So pretty important, and I do think all of this should be taken as bullish for the longer term sense. But again, I'm not a fortune teller. I don't know what is going to happen in the markets, but I want to highlight Wednesday going to be very, very important. The markets are going to move big one direction or the other, either up or down, in a very, very dramatic way. Watch the 405 level on the SPY and then the 400 level on the SPY. If we do come down to those levels by the end of the day today, we only have about 1 hour left of trading in today, and a lot can happen in an hour, so just keep that in mind. So thank you guys for tuning in. Hit the like button, subscribe to the channel, do what you guys got to do. Source your comments, questions, or concerns down below in the comment section. If you guys have any, I would love for you guys to build off of the theory that I just put out to you guys. I think that's very valuable for people to understand potentially what could happen with the Fed if the economy slows down. The Fed might have to raise rates more aggressive to be able to accommodate the economy when an ultimate recession does happen. So those are only my thoughts. like I said, like the video, subscribe to the channel, do what you guys got to do. You guys enjoy the rest of your day, and I will see you in the next one.